Hey everybody, this is Jose Blasco. We are about to start. As always, sound check. That means a quick message on the chat box would be appreciated. A quick hello, a quick good morning, good evening, good afternoon, depending if you're in Asia, Europe, or all the way in the US. Again, just let me know that you hear me well so we can start on time. Thank you so much, Siderman. It's appreciated. I'm going to turn on the video stream so I can say hi from my corner, as always. How are you, Maka? Good to see you. Christian, good to see you as well. 3 seconds to go, everybody. You guys there in the YouTube channel as well, go ahead and say hi, so I also know that all is good. Very good. So we are live, everyone. Today is June 23rd, 2021. Today this is options with options, so the name says it all, isn't it? We're going to be trading options. How are you, Ahmed? Good to see you. And the plan is always the same, isn't it? So approach trading mechanically, look at the markets. Options give you options, as we know. They give us the opportunity to adapt to market conditions. Moving markets, trending markets, volatile markets, non-volatile markets, ranging markets. So we always have some tool, some combination of options that we could put in place to take advantage of such market condition, okay? Always with the risk management and the trading emotions in mind and indeed under control, okay? That's absolutely key. Before we start, disclaimer, on the upper left side of the corner, oh my God, I just made it up there. That was a funny one to say. On the upper left side of the screen, I should have said, you have the disclaimer. Please read it carefully. This is important information. How are you, Furman? Good to see you as well. Again, counting on you guys to have it read it, with detail, because it's important stuff. So the agenda for today, we just said hello. We are simulcasting. So again, quick reminder that depending on where you are watching the session from, could be YouTube, could be Facebook, could be our private room in tradewithufos.com/live. So again, depending on where you're at, you may have different video lags, okay? So again, be on top of those chat boxes when it's time to interact. So when I ask you questions, I can get your answers quickly. Vice versa, when you have a quick answer, make sure you type it quickly, because that way, you still catch me on the same chart, and and therefore your question makes sense to me when I read it. So let's make sure that we are on top of that. And also the other aspect of simulcasting is that we are simulcasting in private and public streams. So public streams would be YouTube, Facebook. Private streams would be our private room on our website. Again, tradewithufos.com/live. And the difference when it comes to the content of the sessions is none. It's the same type of content. I'm just going to do the same thing no matter where we're at. But if you are watching the session in the private room, so then you have full access to the complete duration of the sessions. Where if you are in the public streams, typically after we identify one trade opportunity, we would then disconnect from that public stream, because we understand that the ones of you watching the sessions from the public streams, you are looking at trading more like definitely a serious thing, but also kind of like part-time. So one trade or less trading time is good enough for you. For the ones of you in the private room, you have to be subscribed for that. As you know, you are a coaching plan member, and therefore we understand that you are, as I always say, like me, very passionate about trading, never got enough, always want more, and therefore you appreciate longer duration sessions, and that's why you are in the private room, okay? With all of this said, we always have new people taking a look at what we do. So I sometimes have to repeat things that some of you already know, but that way it's good for all of you if you are new to the community, or maybe you're watching this recorded, okay? Anyway, the plan for today, we'll look at the market, we'll look at past trades, and from there we'll get into finding new opportunities. So let's take a look. Also, Maka, you are here, okay? We need to talk about your trade, isn't it, Maka? Again, happy to get detailed with your particular case, as long as you are comfortable sharing, on the chat box and so on. If not, we can continue our conversation with the emails as well. No, not an issue, but definitely would be better to be able to talk about it while in the sessions, since I could go ahead and utilize charts and anything visual that could help you understand better what happened on your trade, okay, with Tim, okay, but we'll talk about that in a minute, okay. So what's happening with the markets, okay? Well, it's amazing, right? Okay, and well, it's amazing. It's what probabilities mean, okay. So probabilities suggested that you know, when the climate changed from blue to red in a daily time frame. So let me rephrase that. Give me a second, because I believe the values are, let me move to a weekly time frame. Give me 1 second, guys. Okay, so this is the weekly time frame. We move to the daily time frame. Okay, so okay, good, perfect. So I was like, this doesn't make sense. I guess I needed to refresh the chart or whatever. So anyway, so we talked about once the candle goes red, it should stay red for a little bit. You know, statistics suggested 3 candles. It was actually 3, and let's say 3.5, because that was a non-confirmed climate. And from there we changed to blue, and now we are back in an up climate, and statistics suggest it's going to be 9 candles going up. Okay, so 9 candles going up means we're going to start making all-time high again. Okay, so that's what statistics suggest. Having said that, there is a very big difference if you compare what we see today versus what we had the last time that we were looking at the up climate. Okay, and the very you know, difference is that last time we had multiple green UFOs, you know, below price. Okay. This time we don't have any green UFO unless the market falls all the way to 396. So in other words, statistics are absolutely relevant, and this is where we start planning our trades. Okay, so this is absolutely critical. But at the same time, we need to keep in mind that you know, the fact that there is absence of UFOs may basically invalidate all statistics, and who knows what's going to happen. Okay, so again, I would like to see at least one green UFO show up, okay, to be a bit more trusting of those particular statistics, especially if I'm going to rely on this breakout, all-time high, and keep going. Definitely climate suggests that a breakout is going to happen, and it's going to keep going for 9 candles. But the fact that there are no green UFOs, it's a very big question mark for me. Okay, so we'll be observing, okay, and certainly I'll be planning on setups and so on in case that happens. So hopefully we can take advantage of it. Okay, so this is what I have to say when it comes to the market. Now, of course, if we look at the VIX, and therefore we attempt to understand better the options prices, well, you can see how the VIX is kind of flat today, minus 0.66%. Basically, VIX is trading at 16.55, and of course, you know, when the markets go up, typically people get more relaxed, and this is what we see on the options prices. Okay, so not very good for some of the trades that we have. Trades like PayPal, advanced micro devices. So those are trades. Those are double calendars. Those are trades that make money when volatility rises. And what happens? Well, you know, the VIX is not really rising. Okay, maybe the volatility of those individual stocks may be rising, but the VIX is not. Okay, and remember, stocks are contagiously impacted by whatever the market does, right? So if you look at PayPal, for example, volatility, well, actually there is a bad tick here. Okay, there is a bad tick, but volatility went up a little bit. Actually, it's more than what it looks like because of the bad tick, because this low is 0.25 and the current is 0.3. So volatility on PayPal went up like 5%, okay, which is significant, even though it looks very tiny because of that bad tick. And for advanced micro devices, okay, another bad tick. Okay, let me refresh the chart just in case it's a problem on my end. No, it looks like it's a problem on TradeStation servers. So in this case, you know, 0.33, 0.29. So the lowest I see is 0.29 and it went to 0.33. So it's like 4% increase. Okay, so there is a little bit of spice that kicked in. Again, we are still far away from earnings. In the case of AMD is July 27th. So there is still more premium to come in. But you know, when it comes to the stocks, it's better than the VIX because the VIX has been going down. Those stocks, okay, and that's the beauty of using the scanner as well. We are picking stocks that start with a low implied volatility, and therefore this together with the fact that earnings are approaching increases the probability for premiums to go higher, even though it's not that significant. If you compare with the VIX, it's actually quite significant because the VIX has been falling and those stocks had an uptick of 4 or 5%, okay, on implied volatility. So, the trades are progressing in that sense according to plan. And even though, it's, not really helping those trades, the fact that the VIX keeps going down. For trades like Starbucks, which are non-directional trades, of course, the fact that volatility is going down is fantastic because that stock benefits from that because it's an iron condor, okay? But not for other types of stocks, okay? So let's review one stock at a time. Okay, I'll start from the top of the list, okay? We'll start with MasterCard, and this is a trade which is over, okay? So this was an iron condor. We were expected to stay in the purple area until the expiration date. That was last Friday, and that's exactly what happened. Actually, it stayed kind of magically exactly in the middle of the range. So that was a perfect trade. Hopefully, you guys enjoyed it. There was not much to be done, isn't it? It was a very passive trade in this case. There was nothing to be done really. So that's it. The trade is over. But definitely, I guess a good experience for you guys. And therefore, I'm gonna remove it from the list. Another trade I did remove from the list because I closed it myself was TIM. But I'm gonna talk about TIM for a minute because TIM was also a trade that concluded last Friday. Let me move it here. It concluded as also on last Friday. Notice how the purple range is pointing at June 18 as well. So this is also a trade that was pointing at last Friday. And by the way, normally I use a 55-minute time frame. Let me switch that. Here we go. Okay, so here was the purple range, and I closed it the other day, and I collected a profit for it, and I concluded the trade was over. I believe that most of you also closed it, and it was fine. How are you, Joanne? It's good to see you joining us today. And so again, the trade was over, and that's it. End of the story. Okay, but I gave you a choice. Okay, which is also that if that market was to go higher, okay, because if the market was to go higher, enter the blue area, okay, go back above 254. So basically, converting the trade into an iron butterfly was basically going to give you a risk profile. An iron butterfly looks like that, right? So looks like that, and normally, the zero line is here. So whatever is under the zero line is how much you can lose, and whatever is above the zero line is how much you can profit, isn't it? So that was the type of trade that we had. Because we have been working on this trade for a while and accumulated a lot of time decay and everything. So the choice I gave you is if TIM comes back to a higher price, you could convert it to an iron butterfly, knowing that you will still have a little bit of risk on the trade, which is that amount of pain, which was, I believe it was like $60, something like that, something quite minor, in exchange for that maximum peak of profit, which I don't remember the value, but it was significantly more. So therefore, if I'm not mistaken, if I remember well, I said, okay, that's a valid choice. If you choose to convert that into an iron butterfly, know that instead of closing it today and end up with a sure thing profit, you are still exposed to some form of a loss, but it's a very tiny loss compared to the risk that you can take, and some of you may prefer to do that. And then we also calculated what that profit range would be, which is whatever area of that risk profile graph is above the zero line. And I draw the green line above and below 251 and 267. And basically we concluded that all that blue zone was going to be your profit zone if you were to convert to an iron butterfly, okay? So now, if you were to convert to an iron butterfly, okay, and again, this is a good lesson. It was about 900, good memory, Mark. I remember it was significantly more, but I didn't remember the figure. So if you had converted this to an iron butterfly, okay, knowing that you had the 270 call, and Maka, please correct me, okay? Knowing that you have the 270 call and the 260 call, So if you were to convert that to an iron butterfly, you would then add the 260 put, and then you would buy below the 250 put. Okay, and this is, I believe, the trade that you got in place, Maca, and this would be your iron butterfly here, looking to either risk $60-70 in exchange for, let's say, 900, something like that. That was the case. Okay, so now what happened? Well, take a look at what happened on Friday. So I'm gonna move to 618. 618, the closing price was 266.82. Okay, 266.82. We said that as long as you are under 267, you are in the blue zone, which is the profit zone. So the stock ended up in the profit zone based on our estimation, on our simulation done on Thursday, Thursday, I believe it was. No, actually it was on Wednesday, I believe. So that was our estimation, okay? But what I want to talk about, okay, I need to come back to the P&L and the net result of the trade and so on. But what I do want to talk about, okay, is also, what happens when it comes to being assigned and, on all of those things. And also contrast. This we talked about this a bit in the past a few times. When there is this let's call it major fear out there, where when people are assigned options, it's like, oh my God, I got assigned, the world is ending, right? And I remember I told you in multiple occasions that as long as you have your risk under control and you know why that happened and you know how it's happening and what is it that you're gonna do if that happens, so then it's not a big deal. The real big deal is either if you were to be assigned and you don't even know what that is, and now you are long or short shares and you don't even know you are. So that, of course, that would imply a major risk in your account, and this is how people get very badly in trouble. This is obviously not your case. You guys are here in the room listening carefully and educating yourself. So I understand that all of you understand what is assignment. Therefore, most of the times when you guys get assigned, the only problem that really appears on the account is the impact of margin, right? Which is now suddenly, instead of being in an option trade where you are being tied up that very tiny amount of capital, which is the options margin requirement, next thing you know, you are assigned shares, either long or short, and now you need to come up with all the money needed to be either long or short shares, either in a cash account, if it's an IRA account, for example, or if it's a margin account, it's half. So so again, that's an impact, okay? That's an impact, okay? Even though it may not be a problem when it comes to the P&L, okay? You may be assigned and you end up with the P&L you expect. It's two things that are independent, okay? So, make sure that you understand that there is no reason to be fearful of assignment or auto exercise, as long as you know what you're doing and you understand this is something that could happen, okay? So think about what happened with this trade. This trade closed at 266.82. Meaning it was above the 260 put and it was above the 260 call, which are the two options you were short, and therefore the two options that were giving you the risk of assignment. And I call it risk because this is how you say it technically, because the reality is that the risk of the trade, it was also determined by the fact that you are long a call. But again, I'll talk about the 270 call in a minute. So now, if the stock is above 260, which is 266.82, what happens to the put? It expires worthless, so there is no assignment. What happens to the 250 put? It expires worthless, there is no assignment. So whatever premium collected from those two is kept as yours, and thank you very much. What happens with the call side? Well, if the stock had ended up, instead of 266, let's say the stock ended up at 286, okay? Talking about the fear and the risk of assignment. Well, if the stock was at 286, you would be automatically assigned the 260 call and you would find yourself short 100 shares at 260, but also because you are above 270, you would automatically be exercised. So you would be assigning one option, exercising the other one, okay? Which, by the way, for the people that may have bought the call naked, okay, the people that just forget about the iron butterfly, let's say someone bought the 270 call by itself because they were thinking directionally that the stock would move up. Those guys got auto-exercised, and if the stock ended up at 286, they found themselves long 100 shares at 270, okay? So again, not only when you sell options, you get shares. Okay, when you sell options, you have the risk of assignment. When you buy options, you have the risk of auto exercise. Okay, as long as the options are in the money, you get either assigned or exercise or both, depending on where the price of the stock ended up at. Okay, so again, if the price of the stock ended up at 286, the 260 call with assign you 100 shares of stock short, and the 270 call with auto exercise you 100 shares of stock long. So what happens? You are automatically selling short 100 shares, you are automatically buying long 100 shares, so it neutralizes each other, and therefore you are flat. And because the distance between strikes is 10, so then that would have created a loss of $10 minus all the premium collected. That would have given you a net loss of $67, if my memory is right, from when we planned the trade last Wednesday, which we concluded that we had $67 to $70 of risk, or up to $900 of profit based on Siderman good memory, because I forgot. Okay, so you will get those $10 of loss, but remember, you collected all that credit to be in this trade, so then the net P&L would be $67 of loss. Okay, which is not a big deal. Okay, now what's the issue in this case? Okay, what was the situation in this case? And this was a concern for Maca, which I understand perfectly. Okay, so the issue was that the stock ended up trading at 266. So what happens? She got assigned 100 shares short at 260, but she didn't get auto exercise the 270 call. So what happens when she looked at her account on Saturday? Where when she looked at her account on Saturday, she had pocketed all the premium that was paid, to do this initial iron condor, to then be converted to an iron butterfly, and you collected all that premium. But you also found in your account on Saturday that you were short 100 shares of stock at 260. And because the stock went up to 266, it showed a negative P&L of $660. Okay, I'm just rounding the number. Okay, maybe a bit more than that, something like that. So it showed negative P&L. So of course, when you see that like that, the first impression is like, oh my God, I got a sign. I'm losing $600. What just happened? This is terrible. What am I gonna do now, right? What was the reality? Yeah, you have a real-time P&L of negative 660. But that is in exchange for all the premium collected that is yours and has been pocketed in the account. So if you were to do the math, and from that $660 of loss, you were to subtract all the premium collected, well, you are probably in a little bit of a profit because you were inside the blue zone. Again, I don't know how much you got when you did the trade on Thursday or Friday, so I'm not sure how much you got for the Iron Butterfly, but if our estimation, our simulation that we did on Wednesday was right, so you would having ended up in the range here right under the green line, 266 is right under, so you should have ended up with with a little bit of a profit if you were to do the math and you were to compare all the premium collected minus the $660 of loss. Okay, so again, it looks very dramatic when you see your account is minus 660, but remember, you got paid a lot of money to end up in that position, so it's okay. Okay, now with that understood, and please, you guys, please confirm that you have understood this, because now when you talk about what to do if this happens, right? Because the easy thing is, if the stock just goes up all the way to, as I said, let's say 286, because you get automatically assigned and automatically exercised, then you're out of the trade. So on Saturday, there is nothing in your account. You got a loss, but there is nothing to manage because the trade is over. You are in and out. The problem when you get assigned on one of the options, but the other one doesn't get auto-exercised, okay, putting on the side that there is a margin requirement, from Friday until Monday when you close the trade, putting that on the side, which I understand that all of us have extra capital in the account. We don't trade with full buying power, isn't it? We always have excess of capital in our accounts, precisely to absorb, these type of things, to be able to take another trade in parallel and so on. So, it's not, it's not like you're gonna take trades with all your capital and you are 100%, maximizing all your buying power with one trade. That would be crazy. So, I don't think that's a big deal. But again, what to do if instead of getting a sign and then auto exercise with a 260 and a 270, what to do if you end up in the middle, which is what happened in this case if you did the iron butterfly. Okay, let me take a look at your comment there, Maka. So I closed the trade for profit because it gapped down on Monday, but I just thought it was necessary risk because it could as easily have gapped down. That said, what I didn't understand was now 251 to 269 was a profitable zone. Got you. Gap top. Okay, so when you say you close down the trade, you mean the whole trade overall? The iron condor converted to iron butterfly, converted to short shares that then you closed, so the whole thing ended up as a profit? Or you mean the short shares only? Would you mind to confirm that for me, please? Because on Monday, the opening price on Monday, which is right here, was 264.51. Okay, so you got assigned shares at 260. The stock went up to 266, so you would see a negative P&L of minus 660. But then on Monday, when the stock opened at 264, you should have been able to close those short shares by buying them back at 264.51, and therefore you should have collected a loss with the shares of negative 450, which together with all the premium collected in the initial stages of the trade, okay, so all of this would have put you in a profitable position. Okay, you collected 280 premium and was assigned short stock. Yeah, but that was on the last step, I am guessing, right? That was on the last step when you converted the iron butterfly to iron condor. You also collected more premium before when you did the iron butterflies, the iron condor, isn't it? Oh, you waited until it went down, so you were watching it. Okay, so you actually took a profit on the shares by kind of like trailing the stop down, and when it went $1 below your assignment price, then you exited the trade. Well, well done. I mean, it does imply a manual management, okay? And let's face it, when something like that happens, we need to appreciate the fact that we got a bit lucky there, okay? Because it could have gone up, okay? And I know you wrote that a minute ago, so I know you acknowledge that. But well done by being dynamic, okay, in that sense, and do a very good trade management. Exactly, Joan. You read my mind. Okay, so well done. In any case, again, I want you all to understand that when this happens, it's not that big as a deal. But I also want you to understand what to do if instead of it's Monday and you are looking to find a solution for this problem, what to do when you see this problem is going to happen and you want to avoid the problem to happen on Friday. Okay? So let me I read you, Maka. Yeah, it's very clear. So let's talk about this. Okay? So again, recap. Okay? Because it's a lot of information and I know that sometimes it's a bit overwhelming. So we started the trade, okay, as an iron condor. So we bought a call above. Okay, we bought a call above, we sold a call below, then much lower, we sold a put, and then we bought a put. Okay, what happened? The stock was expected to stay in the range. It didn't stay in the range. It went higher and higher and higher. So we decided to roll those lower puts, okay, to a much higher price to coincide with where the short call was, and therefore now we converted the iron butterfly. Let me say that again: the iron condor into an iron butterfly. Okay, when that happened, we changed the purple range, that was the profit zone, we changed that to the blue range, that was the new profit zone, okay? Based on my values calculated on Wednesday, which of course, if you did that on Thursday or Friday, it may be a little bit of a difference, maybe it's 268, maybe it's 266, maybe it's 269, whatever. So we switch from purple to blue. Now, while the blue area is a profit area, there is risk assignment. There is risk of assignment if price ends up above 260 and below 270, or below 260 and above 250. Okay, so if price is in between strikes, there is risk of assignment. Where if price end up above 270 or below 250, then you have assignment and auto exercise, so you're in and out, so there is nothing to be done. The only problem is that now you end up outside the blue area, and now you end up with a loss. But there is nothing to be done from a management point of view. The trade takes care of itself automatically, because one option gets you assigned, one option by auto exercising you gets you out of the assignment. So that's it, end of the story. The issue, again, issue in the sense of management, not because it's a problem. The issue is when you end up in the middle, okay, in between the strikes, because now you're going to be assigned either on the call if it's above, or either on the put if it's below. And if you don't end up outside that range, so now, and you do nothing about it, you will find yourself short shares on Saturday or long shares on Saturday, again, depending if it's the put or the call that got assigned, depending if it's above or below. The issue of ending up with the shares is that now you need more money involved in the trade, which is not a big issue because we have additional capital in the account that normally we'd be able to afford that. And then on Monday, when the market opens, you plan to close the shares and you're done. Okay. What's the real risk? Well, the real risk when that happens is that on Monday you may have a gap against you. Okay. You may have a gap against you on Monday, and if you have a gap against you on Monday, again, the very problematic issue, if the gap was to be a very large gap, is that then you don't have that protective call or protective put that is going to auto exercise you for a limited loss. You could actually now expose yourself to a greater degree of loss. So what is the easiest action to be done on Friday, like 5 minutes before the market closes? Just go long. Okay. So for example, let's say it's here, right? This is 266. And let's say we got 5 minutes to go before the market closes on Friday. So what do? Just go long shares. Okay, you go long 100 shares. Okay, and let the market close. So what's going to happen? You are long 100 shares. You are long 100 shares of stock. You are going to be assigned 100 shares of stock short. The long shares neutralize the short shares. So you're out. Okay, and what's the risk? Well, the risk is that, those last 5 minutes of the day, the market may rally a bit more or drop a bit more. Well, if it drops a bit more, the long 100 shares that you are in will provide, just a little bit more loss. But how much more the market can move in 5 minutes, or if you want to do it 2 minutes before the close, right? So it's normally just a little bit. And now you don't need to go through a margin problem throughout the weekend in case you didn't have capital enough in the account, or you don't need to suffer a gap on the Monday if the gap was to happen against you. In this case, the gap happened in the favor of the trade. So thank you very much, market. But it could be the opposite, right? So easy. If you see this is going to happen, just go long shares if you are above 260. If you are below 260, go short shares. So when you get assigned on the short put, then the long shares of the put neutralize the short shares you got in. Okay, and that's it. Okay, and that's how you would do it. Another way to do it would be to buy a call, but the problem is that probably 2 minutes, 5 minutes before the market closes, those calls are going to lack liquidity, and you may not get filled, and you may try to get filled, and you don't get filled, and then the market closes. So the easy one is just get shares and you're done. Okay, so that would be what to do. Let me read the few more comments on the chat box. Again, it seems that we are getting into a trend since we got multiple trades running and you guys are practicing a lot, which I love. We're getting into a trend where on the Wednesdays, we spend, it's a bit more lecture time when it comes to trade management and a bit less trading time when it comes to new trades. But I guess this is what's needed at the moment by you guys. So I'm happy to spend time on the Wednesday with trade management, and then maybe a bit more time on trading on the Thursdays. Okay, anything is good for me. Okay, no, not an issue. Maca, you don't use translations, you don't have UFOs. Well, I don't know if you know this, Maca, but you can also have the UFOs on TradingView. Still don't see how 251 to 69 was a profitable zone. Maybe we can talk some other time. Okay, this is the right time to talk about this, to be honest. Okay, so let me clarify this for you. Probably the best way to do that will be, just give me 1 second, guys. Just give me 1 second. Okay, and my values are not going to be like yours, okay? But should be good. So So 1 second, guys. I'm just getting a screenshot on my other computer screen so I can share that with you guys. Okay. Okay. So just bringing a Word document here. And what I'm going to have here is just a screenshot I just took, okay, where you can see what did I get on 5/13, okay, which was the day the trade was taken when I sold an iron condor on TIM, which in my case I got 175. Okay, so to this value 175, which is credit you collected, okay, which is credit you collected, okay, to that value you had to do a roll, okay, and this we need some information from you, and maybe it's what you meant earlier when you said 280, okay, maybe when you said 280. So I believe that when you did the roll, okay, so when you rolled the iron condor into an iron butterfly, you got 2.8. Am I correct by saying that, Maka? Please confirm. So if that was the case, that means that you got 280 plus 175 premium. Oh, sorry. 280 plus 175. That was the total amount of premium collected, okay, which is 455. So total premium collected is 455. Now, this is what you collected. In what day? Would you mind to confirm what day? Was it Thursday or Friday? Knowing the last roll was done on, just waiting for your answer. And this is when the video lags, maybe a little bit of a problem, on Thursday. Okay, good. Okay, good. So knowing that the last roll was done on Thursday. Okay, so what does that mean? Well, it means that you have a center strike, right, which is 260, and in a perfect world, the stock ends up at 260, exactly 260. So the call doesn't get assigned, the put doesn't get assigned, and therefore the 455 you made are yours. And it's end of the story. Okay, that's in a perfect world. But what's the problem? Well, the problem is when the stock starts moving higher or lower, then the 260 will start, creating pain, okay? And you have $455 to defend yourself. So at the moment in time when you did the roll, okay, knowing that you have the 270 strike above and you have the 250 strike below, you know that the most you can lose is $10, okay? And if you were to lose $10, the total amount of pain will be diminished by 455, okay? So at the moment when you did the roll, so 10 minus 455, okay, it's 555. So your risk was 545 and your maximum profit was 455. Okay, which is very different compared to what I got on Wednesday. Okay, and of course, why is that? Well, because Wednesday it's further away from Friday. Friday is expiration. And also, when I did the calculation on Wednesday, the stock was lower. When you did the trade on Thursday, the stock was higher. So what happens to the puts when the stock goes higher? Well, when the stock goes higher, the put lose value. So if you remember, the values, and again, this is approximate, I don't remember, but the values I got on Wednesday were $67 of risk, okay, in exchange for $900 of reward. How come I got that on Wednesday? And how come you got this on Thursday? Well, simple, because you waited for the stock to go higher, so the puts below lost plenty of value, and because you got one more day of time decay and Friday is around the corner, so you also lost a lot of premium on time decay. So doing the trade the day after was less advantageous compared to the day when I did the trade, okay? But in any case, putting that on the side, so knowing that, okay, knowing that the more you can lose is 545 and the more you can make is 455, where are your break-even points? So the break-even points are where the maximum profit is collected, right? That's your reference point. So if you look higher, okay, you start, if the stock goes higher from 260, you start in pain. If the stock goes below 260, you start collecting some pain too. Now, how much pain can you afford? 455. So in other words, the break-even points, the profit zone, okay, at that time when you did the trade was 260 plus 455, okay, which is 264. Okay, so break-even point above, I'm going to call it B plus, is 264.55. And the break-even point below, I'm going to call it B minus, the break-even point below, it's 260 minus 455, which is 255.45. So at the time at which you did the trade, given the premium you collected, which was 280, which is obviously different than the one I calculated on Wednesday because the stock was lower and there was more premium. So given your premium, your break-even points were 255 and 264, where my break-even points one day before were 251 to 267. It was a wider range. Why? Because I was collecting more premium when I did the math. Okay, when I did the math, which is, I believe, I did the math when the stock was, more or less here. Okay, was it that day? To be honest, it's too much to remember. What was Friday? Friday last week was when? 16. Why am I saying Friday? I mean Wednesday. Wednesday was here. Okay, so yeah. So when we were surpassing, or we went. Wait a minute, guys. Let me reset. I'm trying to say so many things that I am probably confusing you now. Let me reclarify this. When we did the math last Wednesday, which was on the 16th, okay, let me say that correctly, we calculated the probabilities, okay, we calculated the projected range, which was pointing at 257, which is the dotted line, which was above 254. So what I said at that time is that one possible action was to do the Iron Condor. So this was calculated around that time. So around that time, that's when, if I had done it, I would have ended up with that amount of premium, creating a profit zone from 251 to 267. The difference with you, Maca, is that you waited until Thursday, when the stock was probably somewhere here, okay, where Thursday is the 17th. Correct me if I'm wrong, okay, but this is what I deduct after what we are talking about. So yeah, the 17th is here. So this is Thursday. So probably you waited for the stock to kind of break up, okay? And therefore, because it went higher than my case, so what happens to the puts, the lost value? What happens to time decay? It hit those puts as well, and therefore there was less premium left, and therefore this left you with only $280 of premium, and therefore it created a trade that was less advantageous on the Thursday compared to what was possible on the Wednesday, okay? And that's why your profit zone, which are your break-even points, are looking to be in a different place. So again, this is a very interesting conversation to have. I'm relatively sure that some of you, out of reclarifying and solidifying what I just explained, may need to watch the recording a bit just to, just go over the math and so on one more time. It's really not complicated. At the same time, you have assignment, exercise, profit zone, break-even point. So again, there's multiple, moving parts of this explanation. But I would definitely recommend everyone to look into this, because getting into situations where you get exercise or assign or things like that are not common based on the trade managements that we do. but sometimes it may happen, especially when you have strike price increments, like in the case of this trade, which are $10 apart. Like we were using the 260 and the 270 because there were no strikes in between. So when you have that situation, you have a higher probability of an assignment, and then you need to do your stuff when you do your simulations. So I think that maybe something that happened in your deductions, Maka, and correct me if I'm wrong, because I'm trying to put myself in your shoes and everyone else, is that you were thinking, Jose said the profit zone. Oh, this is hilarious, guys. I just closed TradeStation. I'm gonna have to restart it. Sorry, guys. Okay, that's it. I restarted it. Sorry for that. So you may have kept in your mind, Jose said the profit zone is 251 to 267. I ended up at 266. How come I'm not in profit? And on top of that, I see minus $600 of PNL in my account. Oh my God, what's happening, right? Well, again, remember that you always need to resimulate the trades, especially if you're taking a trade a day after we plan the trade, because everything is moving parts in options trading, and especially as you are getting close to expiration, decay is going to hit hard. So the value of the options are going to change significantly, okay? So it's really important to redo the math, okay? But anyway, Maka, you said I see your point. Again, I would like to get a final confirmation from you and everyone else. Did you guys understand what we discussed? Do you need any additional explanation or review? Again, this is something you need to fully understand, even though it will happen only a few times because we have trade management rules. It is important that you understand, so when it happens, there is no panic, so you know what to do, because if you act on panic, the problem is that you are in that peak status, or of emotional trading. And emotional trading, we know what happens with that. Is that making sense? Cool. Christian, isn't the time decay accelerating really fast? Yes, the time decay is accelerating very fast, and that's why you got much less premium when you do the roll, the closer you are to expiration. So when I was doing the roll on Wednesday, I was collecting much more premium than Maka. Okay? Why? Because precisely the time decay was happening very quickly on those last 2 days. Okay? Yes, key points, the risk of the loss due to assignment, and also you can offset it by buying the shares before the close. Exactly, very good, great, guys. All these conversations will not happen if you guys were not putting the practice into this. Okay, so I'm delighted, beyond delighted. I'm proud of you guys. On if you compare the conversations we had 2-3 months ago and now, it's totally a different story. Okay, guys, so keep up the good work. I'm loving this, and this is how you become an amazing trader, guys. Okay, so keep up the good work and definitely keep asking questions. Okay, Maka did very well, by the way, by sending an email over the weekend. I understood the urgency, and again, while I am a human person and sometimes I am more efficient than others with my emails, of course, you guys count on us when anything like that happens, and shoot an email, okay, guys, and we'll help as much as we can. Cool. Okay, so let's continue. So what else we got? So Starbucks. That one is an easy conversation, right? Starbucks is a trade that we have in the account. At the moment, it's an iron condor traveling towards June 25. If I was to look at probabilities for Starbucks, so loading OptionStation Pro. Here we go. So I need to load the right symbol, SBUX. So Starbucks. Here we go. So what do we have here? So we are currently with a PNL of 16.5. Probabilities suggest 113 to 110. So if we look at the chart, 113 is more or less here. 109 something is more or less here. So it is looking like very, very nice for the stock to end up in the purple area from now until Friday. Friday is 2 days and a half to go. looking nice. We have multiple UFOs below, multiple UFOs above. Nothing to be done. Seems to be a quiet trade like MasterCard. Let's see what's going to happen. Anything could happen anytime, so be ready to act if any of the dotted lines surpasses the solid line, because it means the probability now suggests you may get pain. Okay, so then you will need to start with your rolls. Okay. If you have any question about Starbucks, just let me know. What about PayPal? Well, that one is something that may look a little challenging, isn't it? Because if you look at PayPal, okay, when we started the trade all the way on May 19, we estimated that 288 was going to be the very extreme top of the range and 199 the very bottom part of the range. And, it was such a wide range because we started at like 240. Okay, so that stock has been moving $40. Okay, so if you think about $40 out of a $240 stock, this is like 16% move in, let's say, a month. Okay, a month and a week. I mean, some stocks move 16% in a whole year. We just got a stock move that in a month, right? That was not expected, and it's happening. Okay, so is that a problem? Well, yes and no, because the more the stock stays in the range when we do non-directional trading, obviously, the better. But at the same time, PayPal is a double calendar, meaning this is a trade that makes money as implied volatility rises. And as you have seen, PayPal has gained 5% on implied volatility, as I said at the very beginning of the session. So what's the P&L for PayPal? Okay, well, the current P&L shows as negative 234. Okay, of course, it went all the way past a normal move. So of course it's showing a little bit of pain. Okay, but remember, that doesn't mean anything too bad, because we are using July 16 expiration. Earnings are on their way. The date for earnings is July 28. So as earnings approach, these options may gain another 5%, maybe 10% implied volatility. Let's say it's 5. So if it's 5%, that's not possible. Okay, something went crazy here on TradeStation. Okay, 5% implied volatility increase is not going to make the P&L to be 2,500. It's just not possible. I have no idea what just happened to TradeStation here when I do simulations with volatility. I guess the last update kind of messed up this feature. This is not a normal thing, guys. An increase of volatility will increase the P&L, but not by that amount, okay? But if I do it like that, okay, well, even if I do 0.2%, it still shows a P&L of 2,000 plus. This is just not possible, guys. Okay, so there is a bug on TradeStation. This is not possible. But in any case, you saw it before in prior sessions. I'm sorry for that, but you saw it in prior sessions. When volatility increases, the P&L is going to improve. And it could happen. This will never happen with an iron condor, okay? But with a double calendar, it could happen that the range you expected is now broken by a lot, okay? And you are making a profit. Why? Because think about it. If a range is broken by a lot, and the range was defined by probabilities, meaning the range was not supposed to be broken, but it is, well, there is only one reason for this to happen, is that the stock is moving very fast. And if the stock is moving very fast, volatility is increasing, and therefore you could end up breaking the range big time and end up with a profit, probably a small one, but you may end up in a profit. Okay? So first of all, we're just going to stick with the plan. There is nothing to do at this moment in time, okay, in the sense that it's not like an iron condor where now we are breaking the range, so we need to roll. There is no rolling here because we are relying on an increase of implied volatility, okay, while we still have, remember, we are using June 25, okay, and July 16, so we still need to roll, okay, we still need to roll to July 2nd and July 9. So we still have 2 rolls to be done, which will help to grab more premium another two times. And those 2 additional times of grabbing premium may reduce the cost basis of the trades, which is currently 404, that cost may keep reducing again and again. Okay, why? Because we're gonna roll again twice. And so again, currently we are showing $235 of loss. We may end up with a very tiny loss, we may end up with a tiny profit, or, by the way, when stocks move too far too fast, many times, you end up having a change of trend. I mean, guys, 23 out of 7, I mean, probabilities means that anything could happen anytime, right? And you know what AutoClimate shows is what's probable. What's happening to that stock, it's indeed not probable. So you may have a complete change of direction and a new trend to develop in the opposite direction with a massive profit taking, and that stock drops 5 or 10%, and you are back in very good business. Because if that stock drops to 260, okay, you're gonna make a profit of 500, close to 600. Is that making sense? And 260, okay, is here. Okay, that's where our short options are. Any price movement that approaches to 60 is going to help the P&L of this trade big time. So again, there is nothing to be afraid. There is nothing to be concerned about. Definitely this move was not expected, but here's the very big difference when we do an iron condor and when we do double calendars or double diagonals, which is with an iron condor, if the move that was expected, that the range that we expected is broken, that's problematic and you have to roll. With double calendars, it's not ideal that the range is broken, but it implies that volatility is increasing. And the volatility increasing together with the rolls may offset the problem or reduces your loss to a level where it's not a problem. Okay, so again, nothing to be done. Okay, remember, these are two completely different trades: the double calendars and the iron condors, totally different animals. Okay, guys, so keep that in mind. In any case, something that I also need to mention about this trade is that on Monday, okay, I did get filled on the 230 put for 10 cents. If you recall, the last Thursday, when we were together, sorry for that, guys, I keep messing up with the days of the week. So the last Thursday when we were together, we left an order in the platform with a triggering condition to be triggered on Monday when the market opens at 9:33, if you recall. And we said, sell the 230 put that expires in June 25 for at least 10 cents. It was a limit order for 10 cents. I got filled at 10 cents. I guess that you guys also got filled at 10 cents. This doesn't provide much help, but it's better than nothing. So what happens to this option? Well, of course, you know, it could be time to roll it. Okay, it's now trading at 1 cent. So you could roll it, but we are very likely not going to roll it, because if you roll it, you're going to roll it for 11 cents of credit, which is super little. And then you have to pay a commission to get out and a commission to get in. So 2 commissions because it's 2 contracts just to get 11. So you're going to get less than 11. So again, we're going to do the same thing on PayPal. Okay, we're going to do the same thing on PayPal, which is we're going to set an order for next Monday. Okay, so PayPal. Okay, so here's PayPal, great. So using July 2nd and using the same 230 strike. So you see the puts are trading from 7 to 19 cents right now. So it's very little. So we're gonna sell a single put, okay, with a limit order of 10 cents at least, just like exactly the same we did last week. Same thing we did last week. I'm gonna add a condition based on dates, which is to submit on the next Monday, which is the 28th at 9:33:33. Okay, this is just to be funny. It doesn't need to be 33:33, but just wait a few minutes before the market opens so you get, you know, that liquidity to kind of stabilize. Okay, so this is the same thing we did last week. We're gonna do it again because it doesn't make sense to close it. And if I look at the expiration dates, we're gonna have distorted Greeks all over the place. Why? Because the stock went so far up that all those puts are so far out of the money that all those Greeks are totally distorted. Okay, so we are just gonna confirm and send. okay, and get the order there waiting, okay, in the account. So, you know, we're gonna potentially collect another 10 cents. I'm going to simulate with duplicating the trade in the simulation window. So what would happen if this happens next Monday? So then what would happen is that the 230 using July 2 would diminish the cost of the trade from 404 to 10 cents less, which is 394. Okay, so that would be the outcome, which is basically the same type of trade or very similar type of trade, just with $10 less of risk. Okay, so it's giving you 13. Okay, well, Maca, it's difficult to have a decision if you wish. I would prefer to do it on Monday, to be honest, especially because you know, if the stock keeps going, typically Friday is a profit taking day, so you would expect the stock to fall hard on Friday with some profit taking. So hopefully on Monday you can get a bit more than that, and you avoid the commissions. So I would personally wait, because it's not a very big difference. But you know, if you wanna just roll it so you have it, that's it. You know, it's again, I don't think I will get, you know, too much more on Monday either, but maybe a bit more. Okay, so that's what I would suggest, but your option is valid as well. Okay, now what about the 260 call? Well, the 260 call that expires in the 25th of June, the 260 call provides 6 cents of extrinsic value. Okay. Yes, I'm looking at this right. So 6 cents of extrinsic value with a theta of 0. So we don't have distorted Greeks. Okay, we don't have distorted Greeks. Because, you know, 2 days and a half times 0 is 0, but extrinsic value is 5 cents. So if you do nothing and you wait, you're going to make 5 cents. But also, if you do nothing and you wait, you will get assigned the 260 call. Okay? Which again is not a big issue, because in this case you have a long call that expires on July 16. Okay? Right there. So it's not like the case that we just saw with Tim, where you were assigned shares and you didn't have a call to protect yourself after the assignment. In this case, the call expires in July 16. So you can be short shares and be assigned, and it's fine. It's not an issue. In any case, you know, there is a margin impact. So in order to avoid the margin impact, you have to roll. And in this case, if we roll, the amount you will give up is 7 cents now with extrinsic value, which is super tiny. Now it shows 1, 4, you know, so I would say it's worth it. Okay, so let's go ahead and see what we get paid if we do the 260 in here. So 26 instead of 24. So we may get $200 for the roll. Let's see. Let's simulate that on Thinkorswim. We're gonna see that better. So if we do the roll for PayPal, we take the 260 call, which is currently deep in the money. Okay. Now notice how this option is showing a P&L of negative $1,400. Is like, oh my God, if you close this trade, you will realize a loss of $1,400 in your account. You will. Okay. But you also own a call with $2,000 of profit, and you are about to sell a call with another $2,000 plus of premium. So that's a temporary loss in your account in exchange for plenty more premium to be collected. So remember, we talked about this before, it's fine, okay? So you're creating a rolling order for 7 cents. How can that be? 25, 2 of July. Let me take a look at that again. That doesn't make sense to me. So if we look at the 25 midpoint for the 260, oh, I see that. It's because there is some important slippage. So 26.67 is the midpoint for the 260 in the front month. If we do the next one, July 2nd, the 260 call gives you 26.92. So 26 92, this will provide 25 cents of difference if you get a midpoint. So indeed, you know, there is a decent slippage that is happening with those options at this moment in time. So we have two ways to approach this. Okay, two ways to approach this, probably to be reviewed tomorrow. Okay, but notice that the natural price is to get 90 cents. The midpoint here is to get 7 cents of credit. My Thinkorswim, I'm not sure it's showing me the real time. So let me simulate that on TradeStation. So if I analyze a vertical, let me do this, guys, 1 sec. I know it's a lot of moving parts, but this is what's fun about options, isn't it? So if I look at the vertical, and if I do custom 260, 260, the one I buy is July, and the one I sell is June 25. So you can see that the most you will get is 20 cents, and you may have to pay 70 cents. So slippage is really, really hurting this roll in this particular case, okay? Very, very, very hurting the roll. So this is one of the cases where we're gonna review this tomorrow. We're not gonna take a decision now, but this is one of the cases, let me anticipate what I may confirm tomorrow. This is one of the cases where I may say, let's go for assignment. Because if we go for assignment, we're gonna totally avoid the slippage, okay? And then go ahead and do the trade on Monday with whatever premium we get from the 260, with the added potential benefit that if the stock drops over the weekend, then we get a little bit of a profit on the stock that helps the trade. If the stock goes higher, no pain because we have the call. But if the stock drops a bit, then we get a little extra profit. So definitely that is probably going to be the thing that we're going to do, but I will confirm that tomorrow. Wow. Very long session today with reviewing the trades. Let me quickly talk about AMD. And with AMD, to be honest, the trade is working fine. It's not like it's a problem. So if you look at the P&L with AMD, we are currently making $53. But if you look at what I have in the account, I got 3 units. I don't have 4. And the reason why I got 3 units is because I never got premium enough to sell the put. So this is kind of like a broken double calendar. Okay, it's broken like because it is, right? We have a missing unit, and it's because I never got my 10 cents. Okay, so again, probably something to talk about tomorrow because, you know, we are surpassing by too much the duration of the session, and I want to be respectful with everyone's time. Okay, so we'll talk about that tomorrow. And, you know, Lily, nothing to comment. The trade is doing exactly what we were expecting it to do. So, you know, the stock is doing its correction before potentially a new impulse. Remember, the S&P is probably going to make another breakout, so that stock is probably going to push. And then again, hopefully we end up with our 1,000 over profit before July 16. In the meantime, we have $200+ locked in of profit, which is what the trade is showing at the moment. So no need to be concerned or to discuss this further. So we're gonna stop our session here today. So many things to talk about. Options give you options. Options give you reasons to talk about things. Okay, options give you conversation. And hopefully this is going well for you guys. Again, we'll talk more about PayPal and AMD tomorrow because those trades will imply more to discuss. And then hopefully we'll add 1 or 2 more trades tomorrow as well to the portfolio. So get ready for tomorrow, guys. You got 25. That's great. You got 30 in a live account. Very nice. Very nice. Very nice. This is the other thing. The tricky part when an option chain shows lack of liquidity. Sometimes you get surprises when you place an order because market makers are not getting trades in because of lack of liquidity, and therefore they may take your side just so they get some trades in. because they are market makers. They're in the business of making the markets. So sometimes you get a better price than what you expected. Okay. Now, having said that, this typically happens when your position size is relatively small. So when you are in practice mode, like a student, for example, and you do 1 contract, 2 contracts, 5 contracts, then you may get it. But then if you are trading a large size, you may not get it. Okay. So, keep that in mind. Busy morning, yes. Lots of learning, great, wonderful. Thank you for the comments, guys. It's always a pleasure. It's always, again, my little special moment of the day, guys, to get together and share our passions and learn together and so on, guys. Thank you for joining me, guys. See you tomorrow, same place and time. Keep up the good work, everybody. Take care. Bye-bye.